Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy any investment based solely on the companies we mention. Please do your own research.
Hello and welcome to Monday Upbeat Markets with me, Graeme Dickson.
Me, Kevin Hornsby.
And me, Charles Archer.
And today we are going to talk about the recap of our picks for 2026. We picked 16 stocks. We're going to introduce 4 additional ones. 2 are going to be coming from Charles, 1 from Kevin, and 1 from me. So I don't know how you want to play this, chaps. Do you want to start with the stocks first, or do you want to talk about the situation across the world that we see today?
Well, let's have a look at the macro situation first, I think, because it's a bit of a mess, isn't it, really? Let's be honest. As Charles said before we came on there, I mean, basically Iran has exploded their nuclear bomb, even though they didn't have any nuclear bombs. And that then means that things are going to change. But economically, what have we just done? Or should I say, what has Mr. Trump just done and Mr. Netanyahu? They have just created a huge ball of inflation that is coming down the alley. And what impact is that going to have, Charles, Graeme, do you think, on the world over the next 6, 12, 24 months?
I think it's going to be not ideal. I think it's the third wave of inflation that's coming. Because, for example, in the UK, the inflation target is 2% for CPI inflation. We're currently at 3%. So there's this kind of idea that we had inflation under control. We didn't. It wasn't ever under control. It was just better than what it was when it was in double digits. Now we're in a situation where you could see inflation surge back again to those high single digits, sort of 5, 6, 7%. And I don't see a scenario where that's not going to happen because, whether it's oil or gas or helium or fertilizer or sulfuric acid, even when the strait reopens, a lot of the infrastructure has been destroyed, so it'll take time for it to all get back to status quo. And supply chains, companies are going to want to reinforce their supply chains going forward into the future to make sure they're not relying entirely on the strait. And all that means we're going to get a massive ball of inflation. But also, in some countries it'll be worse than inflation. It'll be, there's no fertilizer, so there's not enough food. There's no oil, so there's not enough energy. Versus, Western countries where we just have to pay significantly more for it. So we shall see. I mean, what do you think, Graeme?
I mean, I know with Trump, he is very stock market orientated, and I think we've seen how the markets have reacted to what has happened in the Middle East, and I think he will probably do something reasonably soon to alleviate concerns. They've got the midterm election coming up in May. I suspect they're not looking great from him, apart from MAGA sort of stronghold. So in terms of later down the line, I mean, the stock markets have tended to do quite well in inflationary environments, not mega inflation, not hyperinflation, but there is a tendency. The one thing you don't want is deflation. That tends to be quite negative for the markets, but I don't know. It depends on what perspective you're looking at, as sort of from a humanitarian point of view, or you're looking from a stock market point of view. Stock market point of view, it may not be that bad.
Well, the question is, the words that he speaks are having less and less of an effect on the market now. Is what it feels like. It felt like it kind of the market ate up his every word. And now they're just less interested in what he has to say. But I also think that it's every other situation that he's previously tackled out of. Whether it was Greenland, for example, or the tariff situations and Liberation Day, or anything else, he could just walk away from the situation. But in this situation with Iran, you have a player that's not interested in letting him walk away. Iran could quite easily say, right, the strait is reopened, back off, we'll have a peace deal and move on. But they've decided not to do that. Having now closed the strait, they kind of have to play out this hand and see what happens. So he will struggle to push it off. On the other hand, I mean, if the last few years have taught you anything, 2020, the pandemic crash, I mean, we were all around when the global markets fell, 30-40% in the space of a month. And then we went on to record highs, and everyone thought, people thought the bottom would fall out of the housing market, and houses in the UK became the most expensive they've ever been. The tariffs came along and people thought we'd have a massive global recession. Didn't really seem to have that much of an impact over the longer term. Russia invades Ukraine. Obviously, we had a wave of inflation for a few months, but then, the global economy ate it. So, it's a combination of, this time it's different. It's very dangerous words in the stock market, but then also past performance is not an indicator of future results. So those two statements are kind of competing against each other, and we don't exactly know. I think the key thing is it's uncertainty. The market doesn't know what's going to happen, and I think neither do we, realistically.
Yeah, we don't know. We don't like uncertainty ultimately, do we? I mean, as investors, nobody likes uncertainty. Though we couldn't be in a world where there is more uncertainty if we tried, probably. I mean, if we look at the bigger picture, and not just focus on the war situation right now, what does the world require moving into this AI world that we are basically running towards, with little or no care of how this will affect us all? But how's that actually going to affect what we require? Now, my view on that is the whole AI data center, electricity requirements, etc., 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 are going to mean that the winners in all of this have to be the ones that are providing the shovels and the picks for this new establishment of that. And that comes, in my view, into three different groups. The first group is the metals themselves, because those metals are going to be required. And when we talked about Ethereum at the weekend there with tantalum, and tantalum's required in all the data centers, then you're going to need a lot of copper to transmit all of this electricity. You're then going to need silver also within the data centers in terms of the use. So metals or resources in general. Then the second part of that is, sorry, you've got two dogs fighting each other outside here. I don't know whether you can hear them or not. Secondly, you've then got the energy itself. Okay, so where do we create the energy from? Where is the electricity actually physically coming from? And then thirdly, you've got effectively the AI centers and the things that need to be created so that the AI can happen, the data centers. So if we are running towards this situation, and you can't say anything but we are running towards it, based on the literally trillions of dollars that are in that sort of magnificent seven in the US, and all that China's pumping into it, and other countries around the world, that money has to go towards this almost unstoppable magnet, which is AI. So those are the three things I think in the next period of time. I can't see how they're not going to be the winners. And I think there's going to be some huge losers as well, because there just is. I don't know whether that makes sense or not, but that's the way I'm thinking.
Imagine landlords of commercial properties could suffer somewhat.
Yeah, unless they want to put an AI center in their building.
That's true.
Yeah.
But in general, I think you've got the work from home environments. You've got now this AI environment. I think commercial landlords throughout the world are going to have a tough period of time.
I think when you're talking about artificial intelligence, the thing I keep coming back to is, I'm only in my 30s, but I remember playing games like Doom or Age of Empires as a child, right? And they were the pinnacle of technological advancement. And you might, maybe you played on a PlayStation 1 or Nintendo 64 at some point.
Yeah, I was on a PlayStation 1, Nintendo, Mario Brothers, and I think I was actually in my 20s, and I finished Mario Brothers, the whole game, but only because somebody ended up telling me the cheats of how to actually jump the different worlds, and I remember packing up the PlayStation at that point, putting it in the cupboard, and I never played it again. That was it.
Brutal. That's very sad for you, Kevin, because but the key point is those games were kind of top of the pops, and now you look back at them and they're just so archaic, right? Even if they've got decent charge and memories. Artificial intelligence is the same. Artificial intelligence that we have now is in its infancy. It's as bad as it's ever going to be. It's never going to be this bad again. And what you think is, think about the phone you had 20 years ago, or the computing programs you had, or the internet that you picked up the phone and then the internet cut off and you had to dial it up again. Even in the past few years, to the point where, like, if you don't have 4G connection on the train into London, it irritates you. And artificial intelligence is the same. We're right at the start of the story, and you think it's working now. Give it 10 more years of data learning. To the point where the work that I was initially doing at the start of my career, it doesn't exist anymore. Artificial intelligence has taken it. And you're seeing this in the level. There's no grad jobs. People graduating university, young people, there are no jobs at all. And where there are jobs, it's in highly specialized sectors, or when you know somebody. But even things as simple as if you the key one, right? If you want to go to university, go to law, do law, get a training contract, become a solicitor. It's highly competitive before, but now a lot of that work that junior solicitors would do doesn't exist anymore because artificial intelligence is capable of doing it, and then it's just reviewed by a senior solicitor. So there's fewer and fewer contracts for training in every professional role. And it's going to get worse and worse. And then what confounds it is that if you have knowledge or intelligence or learning from before artificial intelligence became a thing, i.e. before 2021, 2022, that knowledge and intelligence and skill set is going to become more and more valuable because nobody's learning how to do things from scratch anymore. In exactly the same way as I know how to code on a computer. I wouldn't call myself a coder, but I know how code works. I'd argue anyone, under the age of 25, or anyone who's, gone into the workforce after artificial intelligence became a thing has no idea how to code now. They just ask a chatbot to do it for them. And that has ramifications.
The interesting thing is the most human things, I think, are going to be the most valuable things. And what actual human things are most valuable, in my view anyway, is one, good communication with people, and two, the ability to negotiate with other human beings. These things are not going to be that good in AI for a while anyway. And you're also going to be negotiating with a machine. And at the end of the day, do we want as human beings, or will we accept it, that we will negotiate with with machines? I think we're not going to go away from the do you want to do business with this person or do you not want to do business with this person, if it's not two human beings interacting. I still think that's not going away, and that would be my view anyway.
I tend to agree with you. I mean, when I started my broking career in 1999, this is just when the internet was coming out. And my mates who worked for a big bank said, "Mate, I fear for your role in the future. This advisory brokerage, you're going to get gazumped by the internet. Is literally going to take over." But it hasn't. It hasn't. People still need persuasion. People still need advice. People need someone to sometimes make the decision for them. And I think that there's always going to be an element of that. I mean, but I do think also, Pete, there will be a time where AI is so good that it will there will be some people that were of that persuasion to only rely on other humans who might be willing to listen to advice from a robot.
I mean, it's interesting. I had this conversation with a fund manager over the week, well, a couple actually over the weekend, about capital flooding into small caps because of artificial intelligence. Because my argument is that all the blue chips, the Teslas, the Tescos, anything in the FTSE 100, S&P 500, all of the data, all of the earnings reports, everything that comes out is public, and so all of the analysts' interpretations, have that human eye on them, but artificial intelligence will be able to process them better and understand them better and project earnings better than anybody else. But in the small cap or the growth sector, artificial intelligence won't be able to do that because a lot of the information that's put out or is public is only part of the story. Sometimes you have to go rooting around and find, you have to find out, you need to actually talk to founders, particularly if it's the first company they're a CEO of, see what they're made of. And artificial intelligence, they can't do that. You need to, an RNS comes out, is it actually accurate? Does it tell the whole truth? AI can't tell that. So when you're looking for alpha, when you're looking for, undervalued companies, it's going to become harder and harder the larger a company is because artificial intelligence can analyze them quicker. And so more and more money looking for alpha is going to be forced to go downwards into smaller cap companies because there won't be a choice, because there won't be any way to generate better than index returns.
Yeah, and I mean,
if
we're totally honest, if people want exposure to small caps, what choice have they got in terms of analysis and understanding of how the companies work? There are a group of people who have chosen to say, we will give you some information on those companies, and we are one of them. And that's it. There isn't any other way of understanding other than directly from the companies. And fundamentally, AI isn't going to understand those things. In my view, anyway, that again is up for debate for sure. But rather than keep going round and round in this loop, let's have a look at the stocks that we picked. And let's see how relevant they are to what we've just said, which would be quite amusing because maybe they're not relevant at all. So let's move on to what we picked. Myself and Graeme picked these 12 stocks at the start of 2026, more at the end of 2025, to be brutally honest. But currently the stocks are up about 13.5% on average. And let's start at the bottom. We're going to start with WCAP, which I'm attributing to you, Graeme. And it's currently down 84%. So what say they?
So yeah, not the finest of time. Timing is everything, isn't it? I mean, I still actually believe in their business model. They own about 12% of WeShop, so everything's about WeShop. We talk about WeCap, but WeCap's just the holding company of WeShop. They had this sort of I don't know. It was a weight around their shoulders with this loan note, which has got sorted out now. It's extended until I think May 2027. So that problem's gone away, but the performance of WeShop has deteriorated markedly over the last 3 months. The shares, I think, were trading around about $110. I think when we did the first tips back in the end of
I don't remember what the price was, but it was significantly higher than it is today.
I think today it's trading around about $5.90, $5.80. So I mean, it's had a 90% fall in the share price. They've done hardly any promotion. I think they're on a deliberate blackout in terms of what they can say for the time being. They're under strict SEC rules. So I think for now, they haven't really launched WeShop properly yet. And I think the way they're doing it is they're very much based, rather than doing like a national campaign throughout the whole of America, they're just doing sort of community-led campaigns where they're finding small spheres of shoppers and saying, this is our product, go and use it, and get some WeShop shares in the process of buying your product. So I think they're doing it in a smaller way, regional way, which is kind of the similar model to what Wolfgang Puck, if you know the celebrity chef, he started a brand new chain of coffee shops in America, started regionally. No, this is in a highly competitive coffee market in America, and then he just did it one by one in America.
Okay, so here's the question. If you had to pick it now, would you pick it again at this price?
Yes. Yeah, I would. Yeah.
Okay,
yes.
So still some confidence. Okay, the next one, which is 43% down, I hand it over to yourself again, Graeme. Haydale.
So Haydale, I'm a bit perplexed by that. I think they did a placing at 0.5p, and they're down 50%, and their Barclays are the biggest share. Yeah. So they've almost halved. And I'm a bit perplexed because one of my friends actually they own a subsidiary called Just Heat, and they have all this sort of graphene that's interlaced with this sort of duct tape that goes underneath the floorboards, and it cuts the cost of electricity consumption by a very large rate compared to this sort of traditional pipe, underfloor heating with pipes. So I am perplexed. My friend said it works brilliantly.
And you would think in the current environment now, when electricity is going to be at a premium, if you like, that this is something that can help. Anyway, let's move on quickly. The next two are Besant and Greatland Resources. Charles, I'll hand them over to you, even though they were my picks. They're both basically flat, if the truth be known. We picked it at 0.08. It's roughly there now. And Greatland, we picked at 5.25. It's 5.11. So what's your thoughts?
Well, they shot up initially, didn't they? And they've come back down again, both of them. So they have that in common. I would say, obviously, commodity pricing, gold in particular, we hit kind of the mid 5,500s, and then it's come back down again, as it does every gold bull market. Gold comes back down for a rest before it goes back up. I would say, obviously, the news out of Greatland today with the Telfer MRE upgrade, but also Callaghan's and that tungsten asset. I think Greatland's set up for a great decade ahead. And I think potentially, it got to that sort of £7 a share plus mark. Having come back down to around £5 a share is probably a good entry point for a lot of people if you're looking for like a very long-term investment. It's just a case of execution over the next few years. And as ever, the thing is with Greatland is people get confused often. Confused maybe isn't the right word. Retail investors, many of them think, Telfer is the big story, or Callaghan's maybe the site. It's not. It's Havieron, and that all-in sustaining cost is so low. Once you get to that point, if gold is still trading even at around this price, then the profit margins are going to explode. And that that build out is not that far away now. And then with Besant, it's just a case of we're waiting for this funding that was announced last year, still yet to come through. But again, it's the same deal. It's putting funding issues aside. Once that comes through, great. But the amount of profit that you're going to be generating once it's producing copper, gold, silver from that asset later on this year is going to dwarf the market cap.
Yeah, and if I remember, you did the analysis based on them getting the 90%, and they've got the 90% now, which is obviously a big positive.
Well, it's a huge positive, and it's obviously 90% of a project is a damn sight better than 70% of a project. But I think again with Besant, it's woods for the tree, missing the wood for the trees, right? Because obviously the profit and generating loads of revenue and making money in the first few years, great. But it's actually the drilling and the expansion of those tens of kilometers of strike and getting a large resource that you might be able to sell at some point in the future. That's the bigger story.
Yeah, absolutely.
That, again, is the multi-year reason to be in. Okay,
let's move on to the next one, which is, basically all 5 of these next ones are Besant, Greatland, Solvanus, AJAX Resources, Jubilee Metals Group, all pretty flat, to be honest, though they have all been up. Look at Solvanus, we're basically just waiting for news, aren't we? There isn't anything else to say other than, where's the news in terms of the different drug situations they've got. But it is very cheap for the fact that they've got a stage 3 trial. AJAX Resources also great news through the last few weeks in terms of projects. Graeme, you interviewed Ippolito as well, and then Jubilee Metals as well has just come back down. It went up to 5p and has come back down to 3p. So give us your thoughts, both of you, on those 3.
Well, I'm happy to go first. Solvanus, I think it's phase 3 clinical trials take a long time. when the news updates come, they tend to be very material, but there's not that many of them. So, in a market where, a long-term investor might be, maybe 4 days on the AIM market, people struggle to buy and hold. But I remain convinced that this is a good buy risk-reward profile, not financial advice, but I think it'll do well. And you just need to be patient. The science is being done. Like the trials are being run. You're not going to have your hand held the entire time. It's because that's not the nature. Once you get in, when you're in phase 1, phase 2, you get a lot more information, a lot more frequently. Phase 3, you just don't, and that's the name of the game. With AJAX, I think it's Appian Capital. If Appian is happy to be involved, and that's an institutional validator, if the share price comes down a bit, then it's just a reason to top up slowly over time. If they're happy to be involved, then I think that's enough for me. Obviously, you're not going to make it the core of your pension, but it's definitely a good risk play and worth being involved with. And Ippolito, I think, is very hungry for success, and that helps as well. And then finally, I'm sorry, Kevin, could you remind me? Third one. It was Jubilee, wasn't it? Yeah. So Jubilee, I think, back to the same core problem, which is it feels like whenever it starts to get its legs and its rocket going, somebody sells off. But we know just all you have to do is look at the enterprise value plus the cash from the disposal for South African assets. It's just undervalued on fundamentals. So you're quite comfortable, very comfortable, even buying at 3p plus a share, around 3p. And if you're prepared to wait 12, 18 months, then you'll be laughing. And again, I think potentially, with a lot of these stocks that we're talking about, it is about having that long-term investor mindset. If you want to, if you're looking to generate decent profits in the small cap market, you need to be able to tolerate volatility, but be able to hold for at least 12 months. And if you can't do that, then you're probably going to lose money overall.
Yeah,
because it does just jump up and down. Yeah.
What's your thoughts, Graeme, on AJAX?
I reflect Charles's view about Appian. If you remember, this is the company that Dominic Raab, the former Deputy Prime Minister of United Kingdom, has become a Chief Development Officer for. So this is a company to be take notice of, and to be solely invested in the only public, at least in the UK, the only public vehicle that I know that they're invested in is AJAX. And I think what will probably happen is that they will become a feeder for AJAX for other things that they may have, and they become a source of interest and liquidity for Appian, and raise the profile for AJAX. Interestingly, though, some of the resources, sounds like they're getting rid of it's not SQL, I can't remember the name of the project, the Eureka project. They're looking to sell that. We don't know what the price will be, but that was something we were looking forward to seeing the results, because they were sort of they were doing the drilling, and then they've suspended drilling pending what happens with the sale of Eureka. Let's see what happens. But it seems to me that he's very focused on generating cash, not preserving shareholder funds, and investing in the next big thing. So yeah,
it's quite nice, isn't it? Because obviously, I I've wanted to see Eureka drilled out for a long, long time. It needs to jump from company to company, but it's nice to see that IPO is not married to any one asset. If a deal comes in, you can make some quick money, sell it, move on. Great. I mean, often you'll see offers come in for assets that companies overvalue on their own balance sheets and don't sell them. If you acquire an asset and then you get an offer for it that's at a premium very shortly after, take the money. Take the money and run.
Yeah, absolutely. Okay, let's move on quickly then. Upland Resources, Graeme, up 17 or 18%. That was one of the ones that you had chosen. Give us your thoughts on Upland Resources.
Well, I mean, I'll try and be brief on this. So, obviously, the situation in the Middle East is going to help Uplands. They don't have exposure to the UK, where you have sort of a profits levy, excess profits levy. And then on top of that, you've had recent placing or subscriptions in in uplands which have shored up their balance sheet. One recently by an American set of investors for $1.5 dollars. Let's see. They've got some really interesting. Can't call them assets yet because they haven't had the licenses. I think everyone's waiting for these licenses, and that's the risk. The risk is they don't get these licenses, and then the stock drifts. But I suspect the way the sort of direction of travel is that they will get these licenses at some stage.
Yeah, I think for me the key thing with Upland is yes, you're right about that risk profile, 100%, and there's risks in every stock, and if you're looking for a risk in this one, that's it, But if you want exposure to oil and gas on the main market in London, there is nothing else of the potential growth or scale. I think that's the key thing, right? And there are a certain class of investors who are high risk appetite investors like yourself, Graeme, where if you're going to take on a fairly chunky amount of risk, the upside potential needs to be worth it. And with Upland, the upside potential, I don't think anyone can argue the upside potential, both in the US and also in Southeast Asia, is extreme. And that's, for me, that's the bottom line of it. And if it all goes to pot, which I don't think that it will, but if it does, then the risk profile was worth it. Because there's a lot of companies where the risk profile is similarly dangerous, and yet the upside is extraordinarily capped, and I don't understand why people invest in them. But this one is just the volume of potential oil and gas is just hilariously mismatched compared to the market cap. So we shall see.
Yeah, we shall see. Just need those licenses.
Yeah, indeed.
Okay, so moving on now. The next one is Extract Resources. I'll take that one. Extract Resources. Basically, now looks like Silver King is about to go into production in the next month or so. So we're going to start having capital flows coming in to Extract Resources. It is currently up about 27%. Was up about 50%, I think, from when we picked it at 0.65. It's now 0.825 on this situation, but has been at a penny and over a penny for quite a while there until the war started. So we're going to have production from Silver King, which should produce a significant amount of revenue. We're talking, I think, in the range of $4 to $8 million a year. And on top of that, we've then got the antinomy, which is in Morocco. I think the antinomy is much bigger than everybody realizes, both from the point of view of potentially someone coming in and saying, "Oi, we'll take this off your hands for a considerable amount of money," or the actual production amount. I think the production amount is going to be in the tens of millions of dollars per annum once this kicks off. Which would make the market cap, just like Bezant of Extract, look absolutely ridiculous. And in the back of all this, you've got a project in Australia with 1.3 million tons of contained copper, with a break-even point of about $10,000 value of copper in Australia called Bushranger, and it's got to be worth X million. I mean, at the end of the day, they spent over $40 million on it. So whoever buys is going to have to pay this at the very least. And you got a market cap of less than 10 million pounds. So in my view, would I buy it? Yes. Would I still buy it? Absolutely, 100%. So there we go. Okay, next one. We're going to leave you as the expert on this one, Graeme. Energy Pathways. We said 4.05 was when we said invest. It's currently 5.3, has been much higher, up 31%. What's your thoughts on Energy Pathways? Other than it needs a bloody license.
So the situation with Energy Pathways, it was a bit of education when we interviewed Ben Klube last week. He was talking about Section 35 being that they can actually press ahead with the air compression along with Siemens. And it's not just a UK, it's something that can actually roll out across the globe. But I mean, it doesn't really, the market still has this sort of focus on, and I think rightly so, on the NSTA approval. So when that happens, who knows? But the company's certainly been very quiet, hasn't really been saying much about the NSTA, and we're still waiting. But I think once that happens, I think that will ignite the share price.
I think that if the situation in Iran tells you anything, it's kind of mad to me actually because we had Russia invade Ukraine, and then gas supplies from Russia came under threat. And obviously Russian gas continues to flow into Europe, so no problem. We have the Strait of Hormuz shut down, and now you've got roughly a quarter of the world's liquefied natural gas has gone offline. We still have, compared to Europe, virtually no gas storage. Almost every country in Europe has a couple of months at least, and we have a couple of weeks maybe.
7 days apparently.
7, okay, not even less, 7 days, and it's kind of mad to me because you've got this asset where not only could it's this kind of argument that it would take years for it to be built, but the years are going to pass anyway. So get building. It's kind of like in the early 2000s when we were talking about building loads of nuclear reactors. And the politicians of the day said, yeah, but it'll be 20 years before we see any benefit. Well, I'll tell you what, if we had those nuclear reactors now, we'd probably be much happier from an energy security point of view. Our bills would be much lower. Yeah. And it is, to my mind anyway, energy pathways, more than any single other factor, it's a simple energy security story. We need gas storage. We need that security of supply. We need to have a couple of months, and it won't just be this particular project either. We need multiple. Not just this one. We need gas storage in the UK. We're going to use gas for a very long time. And you kind of have this as well. You have, obviously, the Green Party is getting stronger. The Reform is getting stronger. But you have this kind of idea that gas is dirty. Gas is a hell of a lot cleaner than oil. It's much, much cleaner than coal. If you're going to have a transition energy fuel, it's going to be gas, and our grid runs on it. You need it. It just seems absolutely mad to me that, more than anything else, we have the assets, we have the right people, all the plans are all drawn up, and you're not even asking for government funding either. You're not even asking for government funding. You're just and the most bizarre thing to me is just the lack of. And it's the same in the UK, across everything in the public sector. It's the complete lack of urgency. Why has this not been approved? Or alternatively, why has it not been disallowed? And I'm not. I think it should be approved, and I think there's every argument it should be. But if you're not going to approve it, then say that as well. But then you also have to explain, okay, so where are we going to get our gas storage from? Where's our security coming from? It's just absolutely mad, and it needs to be dealt with.
I did come across a situation where someone with a similar situation, where he had a scientific application, were going to civil servants, where people had degrees in sort of media studies and sociology, and you're asking for something to be approved with a specific sort of scientific background, and the people that are responding and are approving this are not qualified to, at least from a degree point of view, when they look on their LinkedIn profiles, they're not qualified to give those approvals, yet they're put in those positions of responsibility. And I just find that, if that's sort of endemic throughout the government, I'm sure it isn't, but if it is, then we've got problems.
Well, I mean, you need to look at the the politicians we've been treated to. And it just sounds like an attack on Labour, but it is not. The Conservatives were the same. You've got Rachel Reeves, who lied on her CV and is not qualified to be Chancellor. I don't think there's any argument there. She literally isn't qualified to be Chancellor. Angela Rayner, lying about stamp duty. You have the corruption minister being got for corruption. These people are not serious, and they're not competent. But I think the problem is, more generally in the UK, is that everyone that I know that I think would be wonderful in a position of power don't want to do it because it's a poison chalice. Because the reality is that what needs to happen in this country in terms of economically is going to be very painful initially, and no one's going to get voted in on that platform. So we're just going to get progressively more ridiculous parties offering progressively more ridiculous things until the bond market forces a decision. But ideally, we get some gas storage before that happens.
I hope so.
But it's not even just about gas, is it? I mean, we've got a Labour government who basically is saying, no, we don't want that oil that's in the North Sea, please. We don't want it. We genuinely don't want it. We'd rather buy it very expensively from somewhere else in the world, because that's what we're doing. I mean, it's just
or even from
completely
Norway, from the same
nuts.
damn field.
Yeah, the same fields, and Norway are pumping it out.
Well, it's to me, it's this sort of like I'm trying to think of the words. Every year our tax bills go up, literally every single year, because we have an inverse population pyramid. So and also we have a currency that's failing, so the taxes can only ever go up. We are not wealthy enough to not exploit the natural resources that we have. But it's the same in Devon and Cornwall, right? You know, like down here we have what was once the largest copper mine in the world. We have a tungsten asset in Hamerden right next door to Plymouth, which is one of the highest quality in the world. We've got tin and tungsten assets, which are, you know, some of the best in the world. And we should just get mining them. But again, getting any kind of permits or licensing and getting actually up and running with any of this kind of stuff in the UK is just a nightmare. You know, if we're going to buy a load of shit from China, which we do, if we buy a load of crap from China, right, which is pretty much all coal powered, I mean, they are changing now, but, you know, the amount of lignite coal that they burn to make your kind of shitty plastic toys, and yet we can't dig our own coal out of the ground for our own steel plants. We import everything. And it's kind of this idea, we'll become green if we simply switch to like purely green sources of energy. And yet, you know, every plastic that we use is made out of oil that we've got from somewhere in the Middle East. It's just mental. It's just mental.
It's mental.
You're not being more green. You're just exporting it and trying to feel better. But anyway.
Yeah.
Anyway.
Okay, so let's move on to the two that are good winners. 66% up and has been much higher is Guardian Metal Resources. Well, we saw them ring that bell on the New York Stock Exchange last week. So that was really positive to see. And I don't think there's much really to say. You know, they've got a good tungsten asset, two good tungsten assets in Nevada. It's in America. The Americans are going to want this asset, and I can see this going higher. That's my view. Anything to add, Charles?
No, that's it pretty much. I think once you get that US money coming in, you know, I spent most of the past 12 months in New York, going back and forth between the UK and you know, the Big Apple, and the approach to capital, in particular risk capital, is just completely different. You know, if it's simple things like if you've got a CEO that, you know, ran a company and the company failed, American investors won't hold anything against them. UK investors will. Just the sheer amount of capital that's in the US looking for a home is just extraordinary. So, you know, once you get onto like a proper US listing, it might take a while, but the liquidity will surge and the share price should go with it. But, you know, fingers crossed, and we shall see.
Well, the best performer from the list that we chose late last year was Delta Gold. I think it's up well over 150%. If I can have a look here, it was up 158%, and possibly even higher than that.
Indeed. Well, I think there's a few things here. I mean, do you know, when I chat to people, often there's like a triangle, right, of success, and the first thing is like the asset, and the second is the capital position, and the third is the management, right, all the people backing the company. And with Delta Gold, you know, they recently welcomed Pure Bond to the shareholder register, who was an early investor in our other winner, Guardian Metal Resources. And you'll notice that a lot of the people associated with Guardian Metal are also early investors in this stock. So, you know, you're seeing the share price shoot up. But I think the big difference that we have now with Delta compared to the IPO is that initially there was one very highly speculative asset, and therefore it was a bit of a binary, very high risk bet. Whereas now they're investing in various aspects of quantum research across various universities, which is creating a portfolio approach, which is massively de-risking the risk profile. So I think we could see new highs. I think, you know, the quantum area in general is one that's, you know, going to be a growth sector. And I think the key thing is that there's this misconception around the research they're doing that they have to find a massive breakthrough and then they'll sell something for a lot of money, which is not the case. If you look at, you know, things that get acquired by much larger companies in this space, all you need is not even a breakthrough, just like something mildly interesting or research that throws up something new or a different angle or tangent, and then they'll swallow up that IP because you've got hundreds of billions of dollars running around looking for a home. So if you find anything at all, then getting a sale away, well, I think will be fairly easy. But we shall see. New highs ahead.
Okay, so you did a good job with Delta Gold Technologies. I will put my hands up and say that was my pick, and we will see where it goes to. But let's move on now to our picks. Charles, you're going to go first, and then Graeme, then me, and then Charles, you got an extra one as well. So let's go for it.
Indeed. Well, I don't know. I think it's tricky, isn't it? Because there's so many stocks to choose from, and also the quite fun thing about picking at this part of the cycle is that a lot of them are down a lot. So almost anything
exactly, you've got a good chance. You got a good chance from here. We hope
you got a good chance to go from here. I think for my money, this is a risk play, so you could almost call it a moonshot. But defense holdings, I think I'm going to have to throw in there.
Okay.
I think that we have the new CEO coming on board. We will get a contract signed. It's taken longer than I expected, but it will come on board. And then when it does, at some point, the capital will want to find a home for sovereign AI plays, and there's only one listed in the UK. And we had Andy, who I've interviewed a few times, Andy McCartney. We had a photo last week of him outside the door of number 10, right? And Andy talks about being pulled through the doors into important rooms. There is no more important room. You know, there's a whole, if you look, the person he was photographed with, who I'm not going to mention her name, but she's hiring a bunch of people for basically a whole new government department. And the first person she took a photo with was Andy, who's the CTO of this company. It doesn't get more direct than that. And eventually we'll get a contract announcement, and then the interest will resurge and it's going to shoot up. So I'll call that one, from here to the end of the year quite happily.
What price are we looking at in terms of that at the moment?
Must be around 1.25, I'd say. I haven't really paid attention, to be honest. I'm in it for a long time. 1.24. And P. And then maybe one that's a little less moonshotty, a little less risky. I mean, there's a few that I could know. I think Sovereign Metals, I think, is probably my favorite one at the moment because the share price has come back down a bit. I've banged on about this for a long time, but we have the bankable feasibility study coming, I think, potentially in April. When it does, you then have the clock start ticking on a potential Rio Tinto buyout for, the largest rutile resource, one of the largest graphite resources in the world. And it just seems to me to just be a slam dunk based on the market capitalization versus, what will be the net present value of the asset. It's really not complicated. It's just a fundamental story. It's going to get bought out. And that's it. I think that those are going to be my two.
Yeah, Sovereign nearly made it into my picks at the start of the year, so I'm glad you've picked it now. I think it's got a very good chance, yes. And defense holdings we'll put into our moonshot basket. Yeah. So what's your pick, Graeme, then? What's the one that you're going to add?
Well, I've taken a bit of a shine to CRCL. Don't know if you follow this one. CRCL is the ticker. Their flagship project is in Angola, which, of course, if you follow the Afentra story, they're in the middle of an M&A situation. And I think at some stage, Afentra will sort of sail away in the sunset, and that the job will have been done and completed. And I think investor eyes will go on to CRCL. The Con 16, which is their flagship asset, according to a note from Zeus, they're targeting, I think, 247 million barrels of oil, which for a company of the size of CRCL, which is about 45 million pounds, is a large target for them to go for. They'll own about 70% of the project. They're very well cashed up. I think they had about £5 million at the end of December, but they've done a fundraise for about 3.5. So they would have burned some cash. They're probably sitting on about £7 million of cash. So I think it's in Angola. They've also got some projects in Brazil. They said they're going to be looking more in Latin America. It's away from the Middle East. Oil, I can't see oil going down for a long time. So I think CRCL's my choice.
Okay, interesting.
Yeah, I own a decent chunk of shares in CRCL, but I haven't spoken about it much because I don't want it to go up much more because I'm still building that position. But I think you're in for a winner, Graeme. So yeah, good work.
Okay, stop tapping each other on the back, and we'll decide at the end of the year whether you are right or wrong. Okay, I'm tossing up between two. Okay, and I like them very much both. And as you said, Charles, there is so many that you could pick at this stage. It's crazy. But I'm tossing up between Fulcrum Metals, which I think is about to have exponential growth over the next period of time, and Active Energy, which is caught right in the middle of the Middle East, but it's in exactly the space that I think it is. So I'm going to choose for the next 9 months, if you like, Active Energy. I still think Fulcrum's going to do incredibly well, but ultimately I'm going to choose Active Energy. Active Energy is basically providing the electrical connections for AI centers all over the Middle East, in the UAE, in Saudi Arabia. They're in talks with Bahrain. They've got some solar stuff as well, which is in the UK as well. It's got a £3 million market capitalization, which is bananas, considering once the first one is up and running, they're going to be producing close to that amount of money in free cash flow. I think this is a 10-bagger all day long, and I'm quite happy to turn around and say that I think it's going to be many multiples of this price by the end of the year. It's 0.8 to 0.08 to 0.09 as it stands at the minute. It was higher. The war came along, it's knocked it back a bit, which basically means it's in, in my view, like buying territory. And at the same time, they've announced some great deals. All those deals are priced at 0.11, which is 30% higher, or more than 30% higher than the current market price. So yeah, I just don't see how this isn't going to make money. And it fits in perfectly with what we were saying earlier, that if AI is going to progress, energy is going to be important, the data centers are going to be important. And if you look down all of the different things that we've chosen, you've got defense holdings, AI, you've got sovereign metals, the metals that are required for whatever it is, and CRCL, which is basically oil, which is energy. So these are, in my view, the big macro themes that are going to be going forward over the next number of years. I don't see they're going to change. The issue is we've got to choose the right companies that have got the biggest growth potential. And as you know, I like the small ones that can go up lots. And I suppose that's why I've chosen Active Energy. Anybody want to comment?
Yeah, I think Active Energy, a lot of it's fortunately tied up with when this war in Iran ends, And I think the Strait cannot stay closed for any real length of time because the global consequences will be catastrophic. You notice China has now started calling for Iran, for the war to end. So they're starting to feel the pinch. So when it does reopen up, a lot of the stocks that we track will suffer. And then some of them will do really well, and Active Energy will be one of those. I think you could have chosen Fulcrum because the potential there of extract technology, I've been looking at it for years now, is just completely is extraordinary. And when it does go, it will absolutely rocket. But again, it's quite nice actually that, well, maybe nice in the right word, because my own, everyone's portfolios have suffered a bit over the past few weeks. But there's some really nice entry spots for a lot of these stocks at the moment, which you're not going to see. And I think potentially my only takeaway comment from for all of these is that a lot of these stocks are very volatile. So if it's a day or a week where the stock is kind of surging away, you don't need to buy it in that week because everyone's very optimistic. You can wait for a better entry point. Likewise, if a stock is in a particular week or month is not doing particularly well because it's not flavor of the month, that's probably the time to build a position before you get the next hit of news. SVNS being a good example of that. Anyway.
Yeah, I agree. We often jump on things when things are going well, and then go, ooh, now it's worth less. But the thing is, this war has to come to an end. As you said, I don't think there's any doubt it's coming to an end. I don't think anybody's sitting there thinking this could go on forever, because it can't. Literally, the world will implode, will collapse, if this goes on forever. And I think that's the miscalculation that effectively both the US and Israel have made, is that the power that Iran had to cause economic problems, not military problems, was vast. Especially now we see the Yemen and the Houthis getting involved with the Red Sea as well. It's, One thing that I will say, and this really did surprise me, I listened to some podcasts over the weekend about the whole area of demographics in the world. And one of the statements that was made was that China has gone over the cliff now because of the one-child policy. And effectively, China's population is going to halve over the next 35 to 40 years. So is China going to be that big superpower that we all think it's going to be? Because it just doesn't have the people. India is also starting to look more aged than it was before. Russia is the same. And you've got only one or two economies, and one of them was the US, that the US economy is actually not in a bad demographic position. And again, we come back to what has been said whenever we've been having discussions with Rick Rule, that the US dollar just might be the best of the worst. And therefore, my prediction that the US dollar is going to tank and it's going to do very badly. And if we look at the overall long-term basis, maybe, just maybe, it won't, but only on the basis of measuring it against all the other economies that are going to be tanking.
Well, it depends whether any of the other economies move on to a gold standard, which I think it'll be very dangerous. It will not be a pleasant time, but I think eventually there'll have to be some kind of hard asset backing against fiat currencies. In terms of population and demographics, it's interesting, isn't it? Because China, a young person in China doesn't have a cousin. There's no young person in China with any cousins, because they don't have uncles or aunts, because they're single children of single children, which is a crazy thing to think about, but culturally, that's the way it is. And then the thing is, you can have a very, very strong economy because you have a situation when those children are young where you've got 4 grandparents and 2 parents all contributing economically to make sure that one grandchild does very well. But then those grandparents require care, and then suddenly you've got 1 grandchild or 2 parents looking after 4 grandparents. It doesn't work out economically. The other thing which I find fascinating is, when I say growing up, I'm not particularly old now, but when I was going through school and university, all the talk in the world was about overpopulation, right? The world is going to be overpopulated. And now it's switched very quickly. I think you've noticed, people are worried that, the world's going to be underpopulated in the future. People are having fewer and fewer children. And that's the same, we talk about it in the UK, but it's the same across Europe and Japan and Korea and China and Australia and the US. And I think a lot of it is, a lot of people are choosing to have fewer children, but a lot of people simply can't afford the lifestyle they want while also having children. I've got 3 kids and I earn decent money, but we're not multi-millionaires. We're not struggling on any level, but I don't see how anyone earning just 40 grand a year is coping raising a family. And they're just in debt. But it's this kind of, it's this thing, right? Because socially, right, for women in particular, I would say socially, when's the youngest age they can have a child in a Western country where it's not frowned upon? I'd say probably 22, 23, right? If someone has a child at 19, you think, oh, that's super young. 22, 23, you think that's about right. But fertility cliff edge for both men and women starts to fall off around 35. So you've only got about 12, 13 year period where you can have children. And if in those 12, 13 years, a whole generation chooses not to have any or only has one, then you can have a population pyramid collapse in space for a very short period of time. And I think more than anything, that governments around the world are going to start panicking about it in the next 5 to 10 years, because there simply aren't going to be enough taxpayers to keep the pyramid going. And so you're going to see things like retirement ages rising. But then again, it's the same problem, right? Because we could all work into our 70s doing what we do. I grew up on a farm. My elder relatives who were in the sort of 50s and 60s, it gets to a point you physically can't do the manual labor. So you can put up the retirement age as much as you want. People can only do manual labor work for so long, and most of the world still runs on manual labor.
Yeah.
Despite what it might look
How
like
many more
sometimes.
people are going to move into agriculture over the next 10, 20 years, do you think? Because effectively we're going to, one of the biggest resources that is going to be required in the world is food in a proper way. Food that is not, done through the basis of mass production.
I'll tell you something that I just find incredible is we raise our own pigs and cows and sheep and goats and vegetables and whatever else, and to varying degrees. And like, if you eat proper bacon, like proper bacon from like a farm, from pigs you've raised yourself, the taste of it, the texture of it is just so different from something you get in a supermarket. It's almost like an alien fake product. It's just absolutely crazy. And if you get a potato out of the ground that you've grown yourself and roast it, you can just taste the difference in a way that supermarket produce just doesn't. It's so stale, it's so old, a lot of it. Or even you don't need to own a farm to do this. You go down to Italy, right? You go down to like northern Italy, and they'll just hundreds of acres of apple trees. You go pick an apple off a tree fresh in Italy, and it just tastes so wildly different from something that you'll get from the same country. In the UK, I don't know. I think a lot of the food that we eat is just so heavily processed that it's not really food at all anymore.
Yeah,
that's what it feels like. But
yeah, and in Egypt
Anyway.
we don't really get that. It is processed. They definitely use fertilizers and stuff like that, but it isn't. We get odd shaped carrots, odd shaped potatoes, odd shaped whatever. So it is food. You know what I mean? Because not every carrot is straight and long and thick. This is not an ideal carrot.
Well, almost none of them are actually.
Well, exactly.
No, they're generally kind of gnarly roots.
And potatoes the same. Potatoes have eyes in them, whether we like it or not.
Well, I tell you, if you dig out potatoes with a fork, right, that you've grown yourself, it's actually really fun. It's like digging for gold.
Yeah.
You see these little nuggets coming out of the ground. But I'll tell you one vegetable I still don't understand, right, while we're talking about it, is peas. Because if you grow your own peas, right, they're all in a pod, as like people will know. But you have to open the pod by hand and then pick each individual pea out. And it takes about 900 hours to get like a small pan's worth. I don't know how they do it so cheaply. I literally don't. I don't understand it. Maybe there's a machine, but it's just too much effort to be worth it.
I think it's a machine, picks them all off the vine, and then they're smashed, and the peas roll out. End of story.
And crushed.
Anyway,
crushed.
on that magnificent note of peas in a pod, let's call it a day. Anyway, okay, guys, we must say that even with all this uncertainty, we are up as a portfolio. But again, I will reiterate, it's a portfolio. So it was 12 stocks. So you had to invest in all of them to be able to have that gain. And if you didn't, and you just picked one or two and they haven't succeeded, then that's what happens. So my comment is, please have a portfolio of stocks so that you can have diversification, even within companies, within sectors, within situations, so that when things happen like this, i.e. a war, your portfolio will not get smashed because you only got 3 stocks and they were all going one way.
And one more thing to add is that everything we've mentioned is just for your information only. It's not advice. It's just a discussion that we've had. And whether you pick one or the whole portfolio is entirely up to you. But it's on your back.
Yes, on your own head be it.
On your own head be it, but pick them all.
Says the man living in Egypt with no worry of regulatory prosecution. Yeah. You're fine.
No,
We're
but
good.
I'm saying from a portfolio perspective, we cannot just sit here and say, right, I'm picking this. The advice has been given, or not advice, the situation has been shown that many people still just hold 1, 2, 3 stocks. This is not wise. And That's the point I'm making.
It's a fair point. You also have the other extreme, which is having too many. As well.
Yeah. Well, I mean, for myself, again, not advice, but my own portfolio, 20 to 25 names, but I do this full time. I'd argue quite strongly that the average investor can probably track maybe 10, properly. If you're not sitting at a computer working on it all day, every day, then and it's just a small part of your wider portfolio or wider life, then I think you need a little bit of diversification. But I think just in general, I mean, small cap stocks, the idea is, right, again, not advice, but you're looking, most of your money is going to be tied up in blue chips and equities and maybe bonds and gold and REITs and real estate. And maybe sort of 10 to 15% of all of your money might be in the small caps for most people listening. So, in order for it to make it like an actual portfolio implication, you can't spread it across too many companies because, if one, does do a 10x, it won't generate enough money to deliver an actual return. So, yeah, I don't know. And then the other thing is, you also have to accept that some of the things you're going to invest in are going to fail. Alternatively, some of them might drop 70% and then rocket thereafter. And you have to be able to stomach that volatility as well, which is not easy for a lot of people to do.
Yeah, Kendrick Resources being a very good example. I think you bought that a long time ago and bottom draw, and then all of a sudden, boom. That's...
Well, I had the same with Kango, right? Like 3 or 4 years ago when I first bought shares, and then it, fell. I think at one point, I think it was down to 70, 80%, and then it went to the moon, 9x my money from that original position. And I'm not saying, I didn't see that happening. I didn't think that would happen, but you don't actually know. You think you've made a decent investment case. I mean, like Guardian Metal, we spent a lot of time talking about, trying to think of the words. I bought most of my shares at 7.5p after the IPO was at 10p, right? So if you come in at the IPO, then you would have been down 30% or so a few months later. And then when it went to do a 40x return, it's so, if you're going to play this game, you need to accept the volatility. And if you can't do that, then stay away from them.
Yeah.
Would be my general advice, which is not advice. But hey, I feel like we've beaten this particular horse to death. So should we call it a day?
Yep. Okay, well, thank you so much for tuning in, and don't forget to like and subscribe if you like what you see, and remember, mum's the word.
This podcast was brought to you by Monday Upbeat Markets. If you would like to appear on a future episode of the MUMS podcast, please email mondayupbeatmarkets@gmail.com.